Okay, Chapter 13, we're going to take a deeper look at financing. We're going to try to explore what it is that managers think about when they are trying to decide where to get their money. Should they get money from creditors or should they get money from owners? So let's first talk about the concept of leverage. Leverage refers essentially to a magnification, if you can. It's the magnification of the returns that come from additional risks that are taken by the company. These risks come in the form of fixed costs. So the fixed costs that companies ultimately use create the riskiness, if you will, of the projects and the operations of the company. So the capital structure, which is what we're going to explore here, is the mix of the long-term debt and equity that's maintained by the company. So we want to look at how is the company operated. That is, what kind of fixed costs do they have that ultimately leverage the amount of returns and risks that they may ultimately experience. Operating leverage is concerned with the relationship between the company's revenue and its operating income, EBIT. Essentially, operating leverage then measures the business risk of the company. Financial leverage is concerned about the relationship between the operating profit and the earnings per share of the company. The primary variable in between those 2 points on the income statement is interest. So financial risk is what is measured by this thing called financial leverage. And ultimately then total leverage is the combined effect of the operating and the financial leverage. It helps us to explain the relationship between the revenues of the company and the earnings per share of the company. The next step then on our way is to talk about something called break-even analysis. This is just a tool to help us understand how leverage ultimately impacts the returns and ultimately the stock price of the company. So break-even analysis is a process where we want to look at what happens to profits, or find a profit level, if you will, where we can achieve zero earnings. That is, we want to find a point. The operating break-even point is the amount of sales necessary to cover the operating expenses, which essentially is EBIT equal to zero. So the first step is we need to find the cost of goods sold variable piece, right? What are those variable costs of running the company? And then ultimately the next step then is to assess what the fixed costs are. So we need to have some measurements, if you will, within inside the company to achieve or understand what those numbers are. Now, this isn't as easy as it might seem. There are some things that are absolutely variable in nature, and then there are some things that are obviously absolutely fixed cost in nature. But then we do have some a variety of issues and expenses and things that we pay for that have combined impact, that some of the expenses are fixed and some of them are variable. So we need to be able to segment that to provide this analysis for the company. So in real life, it's a little bit more difficult to establish exactly what the break-even point is. For our purposes, though, we really just want to have a way to observe what happens when we employ fixed costs. So the basic format for operating leverage is to find out how we get from sales revenue to EBIT. Right? So we have the sales revenue is price minus quantity. Fixed operating expenses or fixed costs, that's FC. And of course the variable cost is whatever the variable cost ratio is times the units that are produced. The formula here then ultimately gives us earnings before interest and taxes. So what we want to do is we want to rewrite that formula, solve for some things a little bit, and essentially we want to find a place where EBIT equals 0. So if you make EBIT equals 0 and then ultimately solve for Q, we have a formula that's the fixed cost of the company divided by P minus the variable cost. Now this P minus the variable cost is actually a very important variable. It's something that's referred to as the contribution margin. When we start producing and selling products, the first profits that we make have to be used to pay off the fixed costs of the company. And every time you sell a unit, the amount that you have, the contribution towards fixed cost, is this formula. It's the price of the unit minus the variable cost per unit. And when the fixed costs are completely covered, any point thereafter, that is the profit that the company will recognize. So here we have this company, Cheryl's Posters. They have fixed operating costs of $2,500. Sales price is $10 a poster, and the variable cost is $5. So the first question is, what is the firm's break-even point? Well, if we look down below, we can get this from the Breakeven Analysis worksheet. You plug the data in that you know. In this case, break-even units is 500 units. They have to sell at least 500 units in order to break even. In this case, we show, well, what profit is made, or what is the income statement ultimately look like if we have sold 1,000 units. In this case, you can see EBIT is absolutely greater than 0. It's at 74.50. But let's think about what ultimately let's move on to the next example. What we can then find then from this formula is we can see that the blue is the revenue. Of course, the more units you sell, the more cost goes up. The green line here is fixed cost. It doesn't change. It's fixed. And then the variable cost, the total cost, is this red line. So the red cost is the fixed cost plus the variable cost per unit. Where those two things intersect, right here, at 500 units, that is where we would have 0 earnings before interest and taxes. So, how can we ultimately understand what's going on with this? Well, if fixed cost goes up, if we increase the amount of fixed costs of the company, then we would have an increase in the sensitivity. We would have an increase in the leverage of the company. If sales price could go up, we would decrease it. And of course, the variable cost went up. We also would then have an increase in the riskiness of the company. Because in the end, if variable costs go up by themselves, then the contribution margin ultimately is smaller. So it's going to be more difficult to meet our fixed cost obligations. So we can come up with actually some formulas to measure this. The operating leverage can be measured by something called DOL. DOL is the degree of operating leverage. Now, we can actually get it right from financial statements. However, because of negative increases, decreases, etc., this number is frequently kind of misleading. But again, we're not necessarily interested in the specific answer for our company. We want to understand what happens when fixed costs change. So we can look at the formula that we had for EBIT. Fixed cost is in the denominator. So if fixed costs were 0, the degree of operating leverage would be equal to 1. And for every dollar that the fixed cost would go up, the denominator becomes smaller, so the degree of operating gets larger. So a larger degree of operating leverage indicates more fixed costs, which indicates more leverage, and in the end, that means there's more risk. So what would happen here, right? We have this Cheryl's posters again, right? We're going to exchange a portion of our variable operating costs for fixed operating costs. So what this is going to do is we're going to reduce our variable costs from $5 to $4.50, and we're going to increase the fixed operating costs from $2,500 to $3,000. So what would that do ultimately to our break-even unit? Well, break-even unit used to be 500 units. Now break-even is 545. And again, on this particular worksheet, we can see now that the degree of operating leverage is 2.2. So that is the measurement, if you will, of business risk for this company once we have changed and converted some of our operations from variable costs into fixed costs. Financial leverage is the measurement of leverage that comes from the use of fixed financing. Fixed financing is the interest on debt and the dividends that come with preferred stock. Now, preferred stock is not really debt, and its fixed dividends are not necessarily obligations, but if the company has them, we want to include them in the financial leverage analysis. So the degree of financial leverage is going to measure this sensitivity. Again, we can look at it inside the actual financial statements, but again, we can also look within the the income statement itself. And you can see here, if we have any kind of financial costs, interest or preferred dividends, that will decrease the denominator. And if we're decreasing the denominator, the degree of financial leverage goes up, which means in the end, we will have more risk. The leverage is going to go up, but in this case, leverage is going up from fixed cost financing. Total leverage then is the use of fixed costs and operating costs together. It is a combined impact. And again, we can use the financial statements, we can also use the income statements, but quite frankly, I think there's a much better formula here. You take the degree of operating leverage and multiply it by the degree of financial leverage. And this, I think, is very important. We'll talk about this in class because this is a misleading statement that many people make. Many people say that if you borrow money, you add to the risk of the company. And this is not, there's more risk, but it is not an additive function. It is a multiplicative function. So we want to be able to segment or talk about these two different decisions, but it is not an additive function. It is a multiplicative function. So here we have, let's look at a combined problem, if you will. We have a manufacturer. They have 20,000 units in sales. $5 per unit is what they sell it for. Variable costs are $2. Fixed costs are $10,000. They have interest of $20,000. Preferred stock of $12,000. Company's in a 40% tax bracket, and they have 5,000 shares of common stock. So how can we input this? Well, you input the data. We find out that their break-even unit is 3,333 units. So certainly at 20,000 units, they're far above what their minimum is. So they're going to be profitable. But we also can then go down and see here that the degree of operating leverage is 1.2. The degree of financial leverage, 1.8. And when you multiply those together, sorry about that, when you multiply them together, we end up with 2.16 is the total impact of all of the fixed costs on the riskiness of the company.